Hello and welcome to another daily dose of insights powered by Container xChange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and your business. It's Monday, so we start off with a quick overview of what's happening this week. Today we have retail sales numbers in Europe come out, as well as factory orders in the US. Tomorrow, everybody will look at the US because wholesale inventory numbers are coming out. As we've discussed extensively over the past couple of weeks, inventories have played a major role, or inventory destocking has played a major role in the demand slump, especially on the Trans-Pacific. So it's going to be interesting how wholesale inventory numbers develop. Wednesday, Thursday, and Friday, everything will revolve around employment figures, both in the US as well as in Europe, and of course, GDP updates, quarter-on-quarter developments, and an update on the forecast for the GDP growth this year. So a week full of numbers. Stay tuned. I'm very excited about this. Then second point on my agenda for today, I just want to quickly share my screen here. I brought a couple of graphs from our CAX graph, so our Container Availability Index, which essentially measures the difference between container imports and exports into and out of a specific port location worldwide. A level of 0.5, that's where the black line is here on the bottom left, indicates a balance, so roughly the same number of containers enter a port than leave the port, while a number above 0.5 means a surplus of containers, so more imports than exports, and deficit is more exports than imports. Shanghai, historically, if we were looking at the graphs pre-2021, would have been severely negative almost around the entire year. This has changed significantly due to COVID, and especially last year in 2022 towards the second half of the year, where we see here CIX figures significantly increasing and staying be above 0.65. At the beginning of this year, there's no change really. It's significantly flat, so to speak. So that mirrors exactly what we see in the market. Exports ex-China are struggling, especially to Europe and, of course, Trans-Pacific. And into Europe, let's look at Antwerp. Antwerp almost on par with the last year, with 2022, a significant surplus of containers here. So also here, exports are lagging. Let's see whether this follows the trend of 2021 with a slight improvement towards the middle of the year, or rather 2021 with a deterioration or a further increase in import figures versus export figures. And lastly, let's look at what we mentioned, Trans-Pacific. Long Beach, actually very, very interesting. Demand slump in China, so export slump in China means also import slump in Long Beach. And you see here that the CX value is, of course, in positive territory, but significantly below the figures that we've seen over the past 2 years. So there's a more balanced situation, just because imports are below expectations. Lastly, let's quickly look at our xChange Sentiment Index. As a reminder, we ask concurrently industry participants how do they expect the container prices to develop in the near future. And then we form an index out of this, where negative territory means expect a decrease in rates, and a positive sentiment means an increase in rates. So you've seen all over February, up until really the very last few days in February, this was in very negative territory. Negative industry sentiment. This has turned positive in the beginning of March, to now the latest figure here from Friday. This figure has tanked again, so to speak, to -11. So we'll need to see over the course of this week how this holds up, what sentiment does, and of course what the numbers that we mentioned in the beginning of this video will play, what kind of role they will play in this sentiment. Cool, that's it from me, from us for today. Have a very, very successful start into the week. Successful trading for all of you, and see you all on Wednesday. Take care.